Agarwal, Managing Director at Ambit Investment Managers, is now joining in. Dhiraj, morning. Thank you very much for joining in. The consensus seems to be that after a very long stretch of underperformance vis-a-vis emerging markets, no returns for large caps and many mid caps, now is the time. You know, we've got all the raw materials in place, and markets will scale up from here on, move on. The FIs will eventually turn buyers once we get that US-India trade deal. Where do you stand on the market construct from here on for the next 12 months? Are you bullish?
I think next few months I am positively biased. Next 12 months I will reserve my comment at this point of time. And I see a challenge between the macros and the micros at this point. So as you rightly said, macros are still looking good. GDP growth number was outstanding. There is a good possibility that a trade deal will get signed with the US. The GST cuts which the government did should result in some amount of demand revival going into the festival season. But how strong it is, and remember, even after the trade deal with the US, the tariffs will be significantly higher than what it was 4 months ago or 5 months ago. So how do we battle that? How do we manage to grow our exports once again, despite that, into next year? Will determine whether our earnings growth picks up for next financial year or not. So last 4 quarters have been disappointing from earnings growth point of view. Eventually, market will want to see all these macros translate into micro, which is the earnings growth. So jury is still out on that one. So next few months, I'm positive. 12 months, I'm still a little cautious.
Okay, all right. Hi, Dhiraj. Good to see you in. But, earnings in Q2 as well will look a little bit softish, right? You have this adaptation to GST 2.0. So then earnings, we live on hope that Q3 and Q4 will be much better. Is there a possibility earnings actually could disappoint a little bit in comparison to expectations? The scale down expectations is what I'm talking about.
So the current quarter's weak numbers, I think, may not impact the market too much negatively, because I think it's a known fact that post the announcement of GST on August 15th and the actual implementation of GST cut in the 3rd week of September, for 2 or 3 weeks, the consumer demand and consumer sales were likely to be muted, right? Because everybody would have waited for the GST cut to filter into the prices before buying the product. So a little bit of weak earnings this quarter, I think, should not matter much. The acid test will be December quarter numbers. December quarter numbers has to show meaningful improvement for the rally to sustain into next year.
Okay, all right. Dhiraj, the next question I have with you is with regard to this new listing, Urban Company. Clearly, there's a big runway ahead. Most of us use their services, and shareholders will be very happy looking at the listing gains. But if you look at it on a forward multiple as well, it's trading at 100 times. What's your view on these names? In the past, Zomato, you were bang on, or Returnal as it's called. Urban Company, do you have a view, or any other stocks in this new age theme?
No, so this particular company, I don't have a view. But I think the high valuations will have to be seen in the context of, number one, what is the growth? Second, what is the runway of growth potential? So, you gave the example of Zomato. Zomato, our conviction was that the longevity of growth, or the runway of growth, is fairly elongated. And unlike the fears which exist in some quarters of the market, that whole segment has almost settled down to be a duopoly right now. And all new competition is finding it difficult to get their foothold in the market, right? So a duopoly with a long runway of growth visibility, you can justify high multiples, or in case of low EPS companies, obnoxiously high multiples. But for the others, you'll have to see what is the growth and what is the longevity of growth. Otherwise, it could be a trap, as a general comment.
So for Urban Company, is it the longevity of growth that you're not convinced about? Is it the opportunity? Because unlike an Eternal, this has a monopoly in the business that they operate in.
No, as I said, I haven't studied the company.
Okay, got that. So what else are you extremely convinced or bullish about? What are the themes, the top 2-3 themes?
So, the unique characteristic of the current market is actually themeless. So within every sector, you can find companies which are beating the sector's growth and the market growth, and they're doing well. And within every sector, you can find companies which are laggards, and they're actually struggling. So, and that's what is making investors struggle. That what is the theme? That question everybody is asking, and the answer is there is no theme. It's a true blue bottom-up market. The last time I remember, I mean, we have seen bottom-up markets many times in the past, but the most prolonged one was 94 to 98, 99. 5 years. That time Nifty was not so popular, so I remember the sensex numbers. 5 years sensex oscillated between 2,500 at the low and 4,600 at the high. And it was a true blue stock pickers market. I mean, no theme actually worked. So I'm looking at a very similar environment for the next few years.
So that means a 5-year period of sideways movement, no return on the index, similar to, we've done 1 year so far.
I think my view is next 3 to 4 years, mid-single digit returns at best. But individual stocks can outshine if one picks the companies correctly.
With disclosure, can you talk about any of these stocks? Or give us a hint?
No, I mean, I can give you examples. So I mean, I generally don't recommend stocks on media, but I can give you examples. So let's say, let's say within IT services space, I mean, there are few companies which are still growing earnings at near 20% per annum, whereas most of the mega caps are growing earnings only at 5% per annum now. So the 20% per annum growth companies like Coforge, Persistent, Emphasis, and one has to take a look at the valuations as well, can continue to do significantly better than the companies which are struggling for earnings. And similar trend in the banking or the NBFC space. There are still companies delivering in the NBFC space 25, 27% growth without taking too much of incremental risk on the balance sheet. And they can outshine as compared to the general sector growth, which has now come down to below 10. So I think every sector will have a pyramid like that, and the companies in the growth, like a pyramid, the companies in the growth portion, the numbers are few, which is the characteristic of a sideways market. So very, very careful stock picking is my mantra and my advice.
Okay, all right, Dhiraj. Since you're saying the market is not very themeless to a certain extent, you're not very optimistic about double-digit returns, just in the near term. If you're allocating fresh money, between various asset classes, how would you do that? I mean, what would be the broad breakup?
So, because it's still possible to buy bottom-up ideas in the market at this point of time, I wouldn't be significantly underweight equities. I'm still, as an asset class, I'm still very, very positive on gold from a 3-5 year point of view. Everything which is happening globally, whether it is the trade wars, whether it is geopolitics, whether it is bilateral businesses between the multiple countries, which used to happen, let's say in the 70s and 80s, and then it started becoming more of a unilateral US dollar driven system. These are tectonic shifts, and these tectonic shifts will continue to benefit gold as an asset class. So apart from reasonably high weight to equities, I would say some allocation to gold in individual investors' portfolio should be there, whether it is 15% or 20% or 10%. It depends a little bit upon individual risk appetites.
Mm-hmm. Okay, all right. What about, on the domestic front, there are various themes that are potential beneficiaries of this GST rationalization. There's autos out there, cement to a certain extent as well, because they hiked prices a little bit. Now they'll pull back prices, but maybe not to the extent that they, had hiked it. So there could be some kind of gain on profitability front. What would be, or the consumption pack? How would you approach it? The GST 2.0 place?
So the most obvious gainer for such a sharp tax cut are usually consumer discretionary, so which includes automobiles, right? Because in small ticket items, let's say soaps and detergents and toothpastes, I don't think that a little bit of price movement here and there will make that much of an impact on demand. But for, let's say, cars and two-wheelers, television and refrigerators, it does make a meaningful impact. And the GST rationalization has been large. It's not a tinkering, it's actually a significant move down. And that should have some positive impact on consumer discretionary demand, including the automobiles. So that's the space which I think is a clear gainer. Cement benefits, but it's end of the day still a commodity, and most of the gains will eventually get completely priced down. And I don't know if a little bit of a price cut would actually spur, I mean, the demand elasticity to price is so high that it'll actually spur volume growth. In consumer durables and automobiles, I think it should spur a volume growth.
Okay, and within equities, if you allocate money, since you're saying that the headline may not move too much, between the mid and the small caps, what would your allocation strategy be? There was a time at the start of this year where there's a lot of fear that came in, and we have had a set of challenges on earnings, on geopolitical issues as well, slowing down in terms of economy. If you're allocating fresh money to equities, then what would you break it up into if you put it into 3 buckets?
So I call it N-1. You can call it large mid caps or small large caps or smaller large caps if you want. I see earnings growth struggle in the top 10, 15 names in the market. The sweet spot is the next 20 or 30. So not exactly Nifty next 50, but excluding the top 10, 12, 15 names within the Nifty, and maybe some of the top names of Nifty next 50 also. So large mid caps and slightly smaller mega caps, because most mega caps I see will find it very difficult to grow earnings in double digits for the next year or two. So that I think is a sweet spot at this point of time, not really small.
Dhiraj, any view on the solar theme in India? I think today we've got an IPO which is opening up, Satwik Green Energy, small one. They're looking to raise close to about 900 crore rupees. Market cap will be about 5,500, 6,000. Not this particular, but broadly, what is the call on the solar theme in India? Because we're seeing a lot of mid caps, small caps emerge from this sector and attracting huge investment.
So a disclaimer right up front, Satwik Solar is an Ambit IPO, so obviously I'll be bullish on solar.
Okay, but so you're bullish on the entire theme?
Yeah, I think renewable energy as a theme is here to stay and here to grow. So after many, many decades, many years, the energy demand or the power demand is on a structural up move, right? Because of data centers, AI consuming a ton of energy. But it's very, very clear that globally we want more and more renewables as compared to fossil fuel energy. Europe is already at 40%. We want to be at 30-40%. So it's one of those structural growth themes which I think will keep growing for the next 20 or 30 years.
Okay, all right. Good to have you on the show, Dhiraj. Thanks a lot for joining in and filling us in with your take on the markets. Wishing you a good Friday ahead, and we look forward to chatting up with you rather soon.